Well, market volatility has picked up as investors weigh geopolitical risks, along with a potential path of interest rates and corporate earnings season. Joining us now to discuss what investors need to keep in mind is Justin Flowerday, Managing Director and Head of Public Equities with TD Asset Management. And Justin, welcome to the show. I think this is the first time you and I have been on together.
Yeah, great to be here, Tony. Thank you.
All right, so let's start with what's happening in the markets. We're seeing some selling pressure today as markets are focused on geopolitical risk. How should investors be thinking about the current environment?
Yeah, so as you mentioned, investors are reacting to Trump's escalated tariff threats over Greenland and the possibility that what that means for higher tariffs for Europe. I'm not going to hash out all the details. They've been all over the news. But we have another headline, which is producing a higher level of volatility. We've seen the VIX, which is a measure of volatility, back through 20. But I do want to be very, very clear here. This is the new normal. And investors need to be aware of that. Whether it's Greenland, whether it's Venezuela, whether it's Middle East tension, whether it's China-US tensions, we're no longer in the post-Cold War era where governments are being passive and letting private market forces dictate all things about the economy and the markets, right? They're getting much more active. And for investors, this is going to mean higher bouts of volatility. It's going to mean more dislocations in the market. And the way to think about it if you're a long-term investor is that patient capital can be rewarded in this environment.
All right, so let's get to some of the other big debates in the markets right now. We'll start with whether we're seeing a broadening out of earnings strength.
Yeah, so I think we absolutely are. And it's coming from a couple different areas. Number one is related to all of the cyclical areas of the market, which are tied to the broad infrastructure build and all the projects that are getting built out in the US. And so that's industrials and materials and financials. And when you think about all the projects out there, whether it's TSMC's $165 billion fab build out in Arizona or Meta's large data center build out in Louisiana, all of these projects have meaningful second order effects for and demand effects for these companies. And so for industrials, you have increased automation equipment orders, increased HVAC orders, power generation, and so very supportive for the industrial sector.
There's a downstream effect that we're seeing from this.
That's right. You see in materials, right? For every one project they build, they need to build a power grid around that to support power consumption by that facility. So that means increased copper. That means increased demand for steel for building the fabrication, support for materials. You've got financials. All of these projects require project financing. There's securitization of loans that takes place. All of this is very supportive for financials growth. So you look at those three sectors together, which are the cyclical kind of areas of the economy, we're probably going to see, strong double-digit earnings from those sectors in aggregate in 2026.
Are you seeing any broadening out in other sectors? Any other sectors?
Yeah, I mean, the other one I'd point to is consumer. And with the consumer, you have an interesting environment, right? You've had a consumer which, if you're an individual living in the US and you've looked at your investment accounts over the last several years, you've been pretty happy with the level of your accounts and your balance sheet is feeling quite healthy. What hasn't felt as healthy is the cash flow, right? And it's because of inflation and it's because of a whole bunch of different things. But in 2026, could be one of the first years in a long time where the consumer starts to feel pretty good from a cash flow perspective. A big part of that is because inflation is coming down. Another big part of it is related to one big beautiful bill, right, which was passed into law in last July. But for the impact on the consumer, we're only going to start to see that in kind of the first 6 months of this year because we have the tax refunds that'll be issued, and we have a lower a higher standard deduction amount. We have increased kind of childcare rebates, some other incentives which are going to lead to positive cash flow for the consumer. And when you think about the way their cash flow will get deployed, some of it will go into savings, some of it will go into spending. And so for the consumer-related companies out there in the market, there's a slight tailwind that they're going to see, which again speaks to further broadening out of earnings growth for the market.
I want to touch on inflation because that has been obviously in the news quite a bit in 2025. What's happening with rates and what are you focused on?
Yeah, so I'm going to defer to Alex Gorowitz, who's our senior fixed income portfolio manager at TD Asset Management. And I think the way she put it was the yield curve is confused. And it's confused because it's trying to balance what the market participants are seeing as pretty strong economic data out there, along with the potential for a less independent Fed. And so they're balancing that. And look, you look at the data, U.S. real GDP growth has been trending in the 2 to 2.5% range. This is above long-term potential. This is very, very healthy growth for the economy. You're seeing a resurgence in the manufacturing economy. We talked about some of the AI-driven spending and some of the reshoring that's going on. That's continuing to help the manufacturing economy. And the services economy continues to remain very, very strong. If you put all that together, I think there's an argument, a fairly clean argument, that there isn't the need for the Fed to come in and rescue an economy that's still expanding. So how many rate cuts are necessary in order to make sure that we're on the right track and make sure that growth is going to remain stable? And so that's the issue right now, and I think we're going to see a couple more rate cuts, but there's a big dispersion in terms of how much we're going to see beyond that, or whether how quickly we'll revert back to, rate hikes, which obviously won't be a 2026 thing. For equity investors, all this means is, look, in the short term, lower rates are supportive for growth. They're supportive and stimulative for many areas of the economy. I think as equity investors, I think stocks would reward a clearer picture of where the path of interest rates is going to be going, more certainty around that, and more certainty around the independence of the Fed.
Okay, so given that backdrop, where might there be opportunities right now in the markets?
Yeah, I think there are a few different places. I'll kind of speak to the broadening out first. The broadening out is going to happen in a few different ways, I believe, because of earnings growth and other market trends. It's going to happen across sectors, and it's also going to happen across market capitalizations. There's a lot of, as you go down the capitalization curve, a lot of companies in the kind of mid-cap environment that are seeing really healthy demand trends that have supportive valuations that could benefit going forward. I think financials, I spoke about that a little bit, but I think there's still many, many tailwinds for financials, slightly steepening yield curve. I do believe that M&A activity will continue. That'll be supportive for earnings growth. Capital markets activity in general, a healthy consumer, not a terrible environment for credit losses. I think the financials sector, the banks and diversified financials, have a supportive earnings backdrop going forward. And then the last thing I'd say is internationally, there's some interesting things taking place. And if you look outside of North America and even outside of Europe and into the emerging markets, you have some trends taking place which are supportive. You have some policy decisions that have been made that are supporting many Asian countries and demand there. You have a healthy kind of currency backdrop for emerging markets. And I think in general, you could see, given the valuation starting point, some more positive developments for the emerging markets out there.